Joining me now, Mark Noble, Senior Vice President of Horizons. Mark, welcome back.
Good to see you, James.
Yeah, you too, for sure.
What people want to see is they want to see with these Q4 earnings that retail marijuana adult use sales are real and they're meeting expectations. And what we're seeing is, yes, they are. The big guys are able to sell. So even though Canopy had a bit of a restatement on Friday and that hit them yesterday, what we're seeing is they were so far ahead of the rest of the market. Everybody else is starting to catch up. And there's a little bit of euphoria now starting to happen because there was very lofty expectations for adult use sales in terms of these companies generating revenues, and they're meeting those revenue expectations. Aurora's up 400%, Canopy's up 300%. So from a fundamental perspective, when we look at earnings, we want to see that grow. And while those have grown, what people are really looking at is revenue, and the revenue is really what's driving the sort of what we're seeing. So now it's a question of, can everybody else do monkey see, monkey do, and generate revenue growth in the the double-digit multiple, 200 to 400%.
Yeah, so 50% of the cannabis sales in Canada occurred under the banners of Canopy Growth and Aurora,
right?
Which means that there's a whole bunch of smaller ones fighting for that other 50%.
Right.
Do you think that's going to change over time, or do you think that Aurora and Canopy are ideally positioned to defend that 50% market share?
Oh, I think Canopy and Aurora are in a really good position. I mean, technically I don't have too much of an opinion on the stocks, but what we're seeing is they seem to have created a product moat and a branding moat around their sub-brands. Canopy, really surprised on there was the amount that came in from recreational sales. So Aurora is still maintaining a very strong footing in their medical, and we know that they want to go global medical. Canopy has a huge footprint in the recreational. We need to turn that on its head a bit, though. What that means, though, is there's not a huge pot for the other guys. And so what investors need to be aware of is, while companies like Canopy and Aurora and Aphria to a lesser degree are being rewarded right now with this momentum, it also means that if there's any revenue misses from Tilray, which we got coming up in a couple weeks, Hexo, CanTrust, then there will be punished significantly on the other side. And so, and again, it's not earnings, it's revenue. People want to see that in this new commercial market that there's something really there to support the revenue. And the other reason the Canopy, even though it missed again on the profit margins, is we actually saw a decline in sales in Ontario last month because the online recreational sales isn't working to what people would imagine. And anyone who's used that system kind of gets a sense of that. So there's still another leg up with the retail movement, the rollout of retail, and we see already that Canopy has established a leadership position potentially with Couche-Tard. So that's another leg up. So what does that mean for investors that are looking at either HMMJ, our large ETF, or they're looking at the individual stocks? Is dispersion. And when I say dispersion, we're now starting to see a little bit of feast and famine, where if anyone misses on the revenues on a go-forward basis, you're looking at a significant potential leg down relative to the sector. So that is a bit of a risk zone.
Does HMMJF own the Canopy and Aurora?
They own 50 stocks, so they have all the big ones. They would be capped at a 10% weight, and that's really, not to sound too much like a salesman, but that's really what the appeal is right now. Is that what you're going to see is as you get the big movements up on Aphria and Canopy right now, they get captured in the ETF performance. Whereas if you have a concentrated portfolio and you hold any losers right now, you could be looking at a significant dispersion again. So this right now, the revenue and the growth of the sector is really supporting the sector from an individual company to company basis. That's where we got to be a little bit careful, and we got to really watch that revenue numbers.
So the sales of cannabis in Canada essentially met expectations across the whole industry, but only 50% of the 50% of the total sales is divided up amongst the other 98 publicly traded companies that operate in Canada. So does that mean HMMJF would look to lighten up on those companies that are going to be fighting over a smaller piece?
Well, this is the thing about indexing is a market cap weighted.
Okay.
So the weight is established based on the market cap of the company. So it's float. So the larger the market cap, the larger the weight. So as its stock price goes up, its weight in the index increases, and as the price goes down, its weight would decrease. So a lot of those other companies you're mentioning are very small weights. They're like 1 to 2% weights, where Aurora, Aphria, Canopy, Tilray are more in the sort of 8 to 10% range. So we're going to get a lot more of the large cap movement at this point in time, whereas the smaller caps, if they disappoint, they'll have a much less proportional impact on the performance of the ETF.
Right. So is the expectation then, just as an observer, that the performance that's going to be reported by Tilray tomorrow and Aphria eventually is going to be impacted by this reality that 50% of the sales went to 2 companies?
Well, we'll have to see. What they're going to be looking for to see is are they meeting revenue expectations? Not necessarily earnings expectations, but revenue expectations. And it's sometimes hard to determine what the market is. But if they aren't showing the same type of revenue growth that the other large 2 did, then I would imagine that there's a hit to those particular stocks. And it could be that the big 4 or 5 companies have 75% of the market share, right? You could see them take the other 3 big issuers could take the other 30-40%. And we have companies like OrganiGram that, that's what really what started this rally in my mind, is OrganiGram came out of the gate with the first Q4 earnings and they knocked it out of the park.
Right.
And that's where people started to say, oh man, those those high expectations, pardon the pun, are really coming to fruition. And that's really what started this. So again, you could see that, and it's really, we don't know, we really don't know. This is why these earnings are so crucial right now, because they're giving us a little bit of a roadmap, not the complete picture. We're gonna start getting the complete picture when we have Ontario retail stores set up, but it's giving us a little bit of a crystal ball into who has established branding, who's established first market mover positions in the adult use market.
Okay, so then where do you think this market's going for the rest of the year? I mean, it's been on fire since the beginning of the year, and we're looking at a chart right now of the HMMJF, which has, no matter how you slice it, has very well, outperformed. And so the question is it better to own a ETF like HMMJF in this kind of an environment where it's so frothy and there's so much friction in the actual sales marketplace? Or is it better to have a balance of ETF versus more speculative individual stocks?
Yeah, I think you can, I'm obviously in favor of the sector, because what we see with any sector, whether it's technology or marijuana, is high tides rises all ships. So because the level of dispersion among the stocks could be significant and you could see some big losers, I'd rather own the full sector. Of course, you can have both. If you like Canopy and Aurora, you like what they're doing, you can have an allocation to them and then have what your sector beta is on the ETF. Also, the ETF, you're going to generate a yield as well, which you're not going to generate with the other products. So one of the things that we are able to do is, as valuations get frothy, the borrow costs on the stocks get enormous. So back in the height of August, you could borrow rate on Tilray was like 700%. Yeah. Well, the ETF, actually, we take half the stock and we actually lend it out up to half the stock, and so that generates a yield right now of about 7 to 8%. So you're also getting that, and that kind of works as a little bit of a hedge again if valuations get frothy. But we could see momentum now continuing, because you've got now real sales numbers coming out of Ontario to support the market. And you've now got increased liberalization happening on the U.S. People are going to start tracking hemp sales, for example, see what kind of market that is. And so there's going to be a second wave potentially, particularly from the U.S. investors, as more of these Canadian stocks get cross-listed to try to capture this and try to see who's in play now to get involved on the U.S. market. So I think that right now we're seeing the benefit of good surprises on the revenue side from the marijuana producers in Canada, and then the next leg up, and what's going to continue to support it, is if we start to see more sense that these companies that are making money have the war chest now to take advantage of the further liberalization on the U.S. and the global market, which I know I've mentioned here before. And Couche-Tard, certainly with Canopy, would suggest looking at a retail distribution globally.
Do you think there's going to be much of a contribution from the international market ex of the United States?
Yes, absolutely. Because of the margins. So markets like Germany, for example, you're just getting a higher per gram cost, and it's a much larger market, right? You got 50 million people in Germany. So the German medical market could be bigger than the entire Canadian market, just that one market alone. You add in Denmark, Israel, Australia. These are real markets that have, and again, it's just medical, but again, the margins are good on medical. So that's a real growth opportunity for these providers, even ex the US. Now, when you add in, if you add in the US and then you add in the global medical market, if you end up with an adult use market in the US, then you're looking at potentially globally a $200 billion market. But even X out the US, you're probably looking at a $70 to $100 billion market with the inclusion of, adult use market in Canada and a global medical market. So increasingly in Canopy, again, this is where people like what they're seeing, is you're seeing a lot more international revenue coming into Aurora and Canopy, and the analysts are queuing into that. They really want to see that diversification coming outside of Canada.
Yeah, you bet. Okay, so what about Latin America? 540 million customers strong. The only company I know of that's really making headway there is so far as Chiron. Does Latin America figure prominently into the global mix?
Well, I mean, it would, just given the sheer size. Again, though, the question remains is what's the margin per product on that, right? I think if I looked at Canopy's earnings, the average, and I could be, correct me if I'm wrong, but I believe the average price they were sort of selling in the adult use market was around $8. The question I would have about Latin America is, if you end up with the adult use market in somewhere like Uruguay, for example, which is where ICC was before they got bought by Aurora, how much are they actually making? How attractive are the margins in those? So sure, you have a sheer number of people, but from a per gram unit, how attractive is that going to be relative to, I would say, selling to developed markets, particularly Europe?
Right. Okay, well, Mark, that's great insight as per usual. I really appreciate it. Thanks for coming, and we'll have you back again soon.
Oh, great. Take care.